The stock market is filled with individuals who know the price of everything, but the value of nothing. Philip Fisher.
Are you ready to make the most of the only life you have? To make smart money choices focused on achieving what you care about most? Here to help you balance living well today without sacrificing your tomorrow is the Retirement Answer Man, Roger Whitney.
From my heart and from my hand, why don't people understand my intention?
Weird science.
Weird.
Weird investment science. I used to love Oingo Boingo when I was a kid. Welcome to the multi-part series on investment management. And I thought no better song to start this off than Weird Science by Oingo Boingo, because I'll tell you something. In investment management, there is more weird science going on than you can even imagine. Over 27 years of building portfolios with clients, helping them navigate the investment management landscape to create a great retirement. I have probably sat through, Lord knows, how many presentations from investment firms with people that are probably some of the smartest people I've ever met, with pitch books and PowerPoints that were filled with statistics, back testing, and biographical pedigrees that I couldn't hold a candle to. And every meeting like this that I sat through, it all made total sense. I'm like, why would you not invest in this? This makes so much sense. They always made a very compelling case, yet almost all the time, it never worked out quite as it was presented to be. Now, I don't question their intentions. This is generally really good people doing this. The problem is that very few people have a very solid base in the fundamentals of what markets can provide and how markets behave. And when you start to get into this weird science of sector rotation and GARP, growth at a reasonable price, day trading, contrarianism, market neutral, dogs of the Dow, iron cross, all these types of things, you pervert what shouldn't be that difficult of a proposition in building a portfolio to help you get to where you want to get to in retirement. So what we're going to do starting today is we are going to start to place the foundation of understanding what markets can do and how they act so we can be a lot more prudent on how we build portfolios to help us achieve the life that we want, which is sort of the case, right? And this is more important than ever before because you are being bombarded with sources from that are not experts, from financial news stations to magazines to newsletters to bloggers to neighbors to friends to coworkers, tip sheets, yes, and even podcasters, people who are well-intentioned but don't have a very robust foundation on how capital markets work and what they possibly could provide to help you build a portfolio to get your family where they want to go. So we really need to build this foundation. And the reason this is more important than ever before, we're going to talk about in our hot topic segment, but we got to have, what do we got to have? That all-important disclaimer first. It's time for that all-important disclaimer. Hey, we're going to talk a lot about investing over the coming weeks. So remember, you cannot invest directly into indexes. Different types of investments have lots of different types of risks. And you need to make sure that you pick something that's appropriate for your situation. So don't take advice from me on the show. Consult your legal advisor, your tax advisor, or your financial advisor so you can make right decisions for you. With that, let's get on to the hot topic segment. Welcome to the hot topic segment where we are going to talk about why it is so important to have a really strong foundation when you are investing as you enter retirement. It's pretty important. So a week and a half ago, I went to Dr. Gallman. Dr. Gallman is my local general practitioner. I've gone to him for probably 15 years now. He knows my wife. He knows my kids. I know the nurse. We see the receptionist everywhere. She always asks how the kids are doing. And Dr. Gallman in the office, everybody in the office, they're wonderful. And I go to him for my checkups and my blood work and, when I have a sinus infection. Well, last year when I went to him because of my knee, it was something Dr. Gallman really couldn't deal with. I mean, he could identify it, but thankfully he didn't sit there and try to fix my knee for me. What did he do? He sent me to an orthopedic surgeon because that really needed expert counsel. And I was very thankful that he did that because my knee, although it's still a little wonky, it's a lot better. Well, as you are getting ready to retire, it's very much that way because likely, if you're 50 or older, you have been accumulating assets for decades, right? Whether it's in your 401k or in real estate or in your business. If you own a business, you've likely been accumulating wealth in some fashion. You've been saving and investing and sacrificing to build wealth for you and your family. And that accumulation phase is like going to a general practitioner. It's not specialized. It's not that difficult because you have such a wind at your back as you're investing. So what do I mean by having a wind at your back? A wind pushes you along. And when you're in this accumulation phase, like you've probably been for decades, you have a long-term time frame, right? This money is for retirement. I'm not even thinking about this money. I just keep throwing money at it, which allows you to have patience to allow it to grow. So that's a big benefit in the accumulation phase. In the accumulation phase, when we have big market downturns, you can anchor to, but I'm long-term. I don't need this money for 20 years. No biggie. And then you also have the consistent contributions, whether it's into your 401k or into your business or into real estate or whatever it is. You have those consistent contributions going in. So when we do have those downturns, you can say, hey, I'm still putting my $1,000 a month into my 401k. Now it just means I get to buy more shares because the price is lower for my same $1,000. So statistically or from mathematically, when markets go down, especially earlier in the accumulation phase, it actually benefits you because you get to buy more shares at lower prices with that same dollar investment. And then lastly, when you're in the accumulation phase, sometimes this isn't even said consciously, you can earn your way out of really dumb investment mistakes in really bad markets because you are earning in your career. Likely you're growing your earnings over time. So when you make a really stupid investment decision, or one doesn't work out, or you go through bad markets, your earnings power is still there and possibly increasing. And that's comforting. You can just sort of gloss over a lot of mistakes. There are probably some pretty big investment skeletons laying behind me that I was able to gloss over because of my earnings. But as you get closer to retirement, that wind that has been pushing you along in the accumulation stage all of a sudden changes direction and starts to come right at your face. So I'm a cyclist. So if you're riding with the wind at your back, I'm going to tell you, you feel like you're really, really fast because the wind's pushing you along. It's a lot easier to pedal. It's a lot easier to invest with that wind at your back. But anybody that's ridden a bike and then turned around to come home after they were thinking they were really fast, and all of a sudden that wind that was pushing you along is actually in your face, pushing hard on you, it's really loud and it slows you down and it takes a lot of effort. And when you let off the pedals in some way, it's harder to gain momentum back up. Well, as you're nearing retirement, that wind changes direction. All of a sudden, that long-term time frame, well, it didn't help you near as much. It hurts you Because rather than investing for the long term, you may be taking money out for the long term. So that long-term time frame really hurts you. Downturns in the markets can really hurt you. If you retired at the beginning of 2007, depending on dividends and interest rates and real estate or whatever it was, that downturn could have destroyed your retirement. So downturns can really have a dramatic impact on whether you're successful or not. Now, those consistent contributions that you were making in the accumulation phase, where when markets went down, you were buying buckets of shares, now that math is totally reversed. So rather than contributing, say, $1,000 a month, let's say you're taking out $1,000 a month to help subsidize your retirement lifestyle. Well, when markets go down, you still need that $1,000. And if you're selling something to get that $1,000 and the prices have really gone down, now you have to sell more shares of that investment to get you the same $1,000, which means when markets recover, you're going to have less shares available to recover, and that can really destroy your retirement. So now that math is totally reversed on you. And then lastly, as you start to prepare and enter the retirement phase, you can't as easily earn your way out of really bad investment mistakes or bad markets. Your earnings power isn't ever increasing. It may actually be decreasing or stopped altogether because you've left the workforce. Now you don't have that power to make up for missteps. I was having a conversation with someone just last week about the last 2 years' experience that they had. They had been with an advisor, and they said, "We haven't earned any money in 2 years. Is that reasonable?" I think the last 2 years have been pretty good earnings years, right? And they didn't feel like they were getting the communication they wanted or needed from the advisor. They didn't think the advisor was really invested in what they were working on, which is going towards retirement. And so they were looking for a new advisor, and this is a friend of a friend, so I was just helping guide them. But the tone, and they basically said it, "Man, we missed out on 2 years of potential returns, yes, but they also missed out on 2 years of actively planning and taking intentional action to position themselves for a great retirement." That's sort of like if I would have stayed with the general practitioner and had him figure out my knee. He didn't have any specialty there. He wasn't super focused on my knee being better, other than doing, some rudimentary things. I would have wasted 2 years of cycling and absence of pain and everything else. If you're getting close to entering retirement, it's time to get your wealth working for you. Mistakes cannot be easily made up. So the question is, how diligent are you going to be? You've had the wind at your back from an investing standpoint for decades. You may have a false sense of confidence, even listening to some of the weird science that's out there, because the weird science may have worked because you had this wind pushing you along anyway. How diligent are you going to be in not just managing your retirement, but managing your investments and basing it not on weird science, but on sound science and academically rigorous research? It's a good question. And we're going to start building that sound foundation in this week's practical planning segment.
Huh? What does that mean?
Welcome back to the What's That Mean segment. Now, I'm bringing this segment back because we are going to get a little geeky here over the next couple weeks as we build this investment foundation. And I want to make sure that you get where I'm going and you know what we're talking about. So we're going to keep it as easy as possible, but there are some basic things you need to understand what they mean. So each week we're going to talk about some of the terms I'm going to be using to make sure you have a solid foundation when you hear these words. So today I want to define a couple terms that we're going to use in the practical planning segment. And the first is asset class. We want to talk about what is an asset class. Well, an asset class is a group of securities that exhibit similar characteristics that behave in a similar fashion in the marketplace. As an example, real estate is an asset class. Now, the term real estate could mean home real estate, commercial real estate, industrial real estate, retail real estate, all sorts of things, right? So that would be an example of an asset class. Large cap stocks, large capitalization stocks would be an example of an asset class. A large capitalization stock would be stocks that are worth a certain amount or more that are considered some of the larger, more prominent companies in, say, the United States. So large cap is an example of an asset class. And you have various asset classes like international stocks, emerging markets, small cap stocks, and then you can slice and dice it any way you want. So that is what we mean when we talk about an asset class. It's just a group of securities that have similar characteristics and act together. And that's something you'll see a lot when you're talking about investment management. So today, we're also going to talk about returns. Now, returns seems like a normal term, right? Returns, yeah, I give you money and then you give me money and some more money, and the difference is my return on investment. So returns are made up of two things. If it's an equity, it's going to be made up of the price appreciation or decline. If you buy it at $1 and it goes to $2, then the difference between $1 and $2 is the appreciation, and that's part of your return. The other part of your return is going to be any dividends that it pays you, and we'll talk about the importance of dividends in a little bit. So that in an equity would probably make up your returns. In a bond, it would be any appreciation or depreciation, and all the interest that you earn would make up the return, and so on. So that is what returns mean. Now, lastly, what I want to talk about today is the capital market assumptions. We are going to establish some basic capital market assumptions on what returns you can get from major asset classes. So what is capital market assumptions? They are estimates on the expected return, for today anyway, on given investment opportunities or asset classes. So if we say large cap stocks, when you're building a foundation of investing, you want to know, okay, what can I expect in a return from large cap stocks? That is what is considered the capital market assumptions. Now, there are all different ways of calculating what you expect your return to be from an asset class. There are people that just use history. There are people that use history and then they skew it based on their forecast going forward. For our purposes, we are simply going to use history because we're not in the business of predicting the future. We just want to use the data that we have to build reasonable expectations of what an asset class has done in the past. So that's what we're going to do when we get to capital market assumptions. Are we all good there? I'm going to try to keep this simple. But now let's get to the practical planning and get into what are the capital market assumptions for some major asset classes so we can start to understand what the capital markets can actually provide us to help us achieve a great retirement. Hey, welcome to the practical planning segment. I'm imagining that some of my geeky friends that listen are like, yeah, let's get into investment management. And then some of the non-geeky ones are like, ooh, this is important, but I don't want to get lost. So let me tell you how we're going to approach this. So this week, we're just going to set some return assumptions for the big asset classes. What have we seen in the past in terms of returns from stocks, bonds, cash, etc.? Next week, we're going to flip it around and we're going to talk about risk. We're going to talk about, well, how do we measure risk and how risky are these asset classes? And we're going to look at risk from a couple different angles. And then we're going to talk about how do we manage risk to hopefully get returns that we need for retirement. Lastly, we're going to talk about, okay, how do we, say from an asset allocation point, how do we pick the investments we put in our portfolio? Do we use something that simulates an index? Do we use active managers? Do we use alternative investments? All that stuff. Now, I don't want to disappoint anybody, but I want to explain the philosophy that I take in building portfolios with clients. I take the Bruce Lee philosophy. So Bruce Lee once said, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times. That's the philosophy I use in managing assets with clients because my goal is for them, hey, let's achieve this life. And most of the time I see things way overdone. Too many different things happening. I'd rather do fewer things really, really well, hopefully, and very diligently. So today we're going to look at the asset class returns for cash, bonds, and stocks. And then we're going to look at inflation and how that impacts all this stuff. For all the data that I'm using, I'm getting from Dimensional Fund Advisors, which is a very academically rigorous firm. And they put out a fact book every year that has tons of statistical data. So that's where I'm getting the data. And I want to remind you that we're going to be talking a lot about index returns, and you cannot invest specifically in an index. It's just a theoretical model. You have to buy something that's simulating it. And then all different types of investments have different types of returns, and we don't know what those are going to be. And then everything we talk about that's happened in the past may not happen in the future. So remember that, okay? So the first investment we're going to talk about is cash, or what we call the risk-free rate of return, meaning if we think of risk as volatility, its ability to go up and down and lose money, then we think of cash or cash-like investments as the risk-free rate of return. So what are some examples of cash? Well, obviously you have your mattress, right? But savings accounts, money markets, treasury bills, which are bills issued by the Treasury that generally mature in a month or so, CDs. These are things that are considered the risk-free rate of return or cash. So the question is, what has cash returned you, the investor, over the years? And given today's interest rate environment, you're probably saying, well, nothing, right? But you're probably old enough to remember the 80s when cash was actually paying not so bad on a nominal return basis. So we're going to use the 1-month T-bill, 1-month Treasury bill as the proxy for the risk-free rate of return or cash. And if we go back over the last 50 years, and I'm just picking 50 years because I like that number, I'm 50 years old right now, cash has had an average annual return, according to Dimensional, of 4.9%. Man, we'd kill for 4.9% right now, wouldn't we? Right now, I think the yield on the T-bill, the 1-month T-bill, is 0.72%, so not even 1%. So that is going to be the nominal rate for what we see cash. Over the last 50 years, 4.9% is the nominal rate for T-bills or for the risk-free rate of return. So that's option number one. We just keep all of our investments in cash. Well, what's the next step out? So the next step out is we're going to look at bonds. What can bonds give us as a return? Now, first, I want to stop here. So let's define what a bond is, because it's a term we hear all the time, but it's basically lending money. So if I lend money to Johnny, Johnny is going to agree to pay me back a specific date. Let's say Johnny agrees to pay me back in 1 year's time, and I give him $10,000. So I have a maturity, 1 year's time, when Johnny's going to give me my $10,000 back. And then I'm not just giving Johnny the money for free, so I'm going to charge him to use my money, which is a coupon rate or an interest rate. So I'm going to say, okay, Johnny, I'm going to give you that $10,000 for a year, but I want you to pay me 5% every 6 months. So every 6 months, he writes a check for 5% or 1/2 of 5% to me, and that's interest. That's the return I'm getting for letting Johnny use my money. That is essentially what a bond is. It's an IOU. Now, that's very basic. And then 1 year's time, Johnny gives me my money back. But in the real world, we don't know how trustworthy Johnny is. So the other thing that generally comes into play when you're talking about bonds, we don't know how trustworthy the person borrowing the money is. So if Johnny is my lifelong friend and he's never let me down, maybe I'll charge him 3% interest because I'm not too worried about my money. If it's not Johnny and it's Billy that wants money, oh Lord, Billy still has my weed whacker from 8 years ago. And I know Billy, he can't keep a job. So Billy is nowhere near as trustworthy is Johnny. So if Billy comes and wants to borrow $10,000, well, I'm probably going to want some better collateral, right? I want some proof that he's going to be able to pay me back. And I'm probably going to charge him a much higher interest rate. So rather than charge him the 3% I was going to charge Johnny, I may charge him 10% on that $10,000 because I may not get my money back and I need to get better return. So that's the other factor, and that's called a credit rating. And credit ratings go from AAA all the way down to BB and below. So there's a lot of factors that go into bonds. What we're going to look at when we look at what are the return expectations given the last 50 years of history for bonds is we're going to look at long-term corporate bond rates. So we're going to look at the long-term corporate bond index. And over the last 50 years, bonds, I'm just going to say bonds, using the proxy that we're using, has had an average annual return of 7.9%. So we had cash, or the risk-free rate of return, that over the last 50 years averaged about 4.9%, which seems high today, and long-term corporate bonds, which over the last 50 years averaged 7.9%. So you get paid a little bit more for lending money to someone other than the government. In this case, about 3% more. So that's the next step out. So you have your cash. Wow, I could get a better return, potentially, if I put money in bonds. Now let's go out one step farther in building this foundation. Let's talk about stocks or equities, which is what everybody talks about nowadays because we're getting so little returns in bonds, in cash, that a lot of people are looking for returns in equities or stocks. So for the purposes of this discussion, we're going to define stocks as the S&P 500 index. So the S&P 500 index is a broad-based measurement of changes in stock market conditions based on the average performance of the 500 widely held common stocks in America. So we think of it as unmanaged. It's just this basket of 500 stocks. But in reality, the S&P Corporation, Standard & Poor's Corporation, has a committee that manages what those 500 stocks are. And over time, they have changed, sometimes very dramatically, because they're always trying to represent a large swath of the U.S. economy because it's meant to be that benchmark. So the Standard & Poor's 500 was started in 1923. What's interesting, up until about 1956, I believe it only had about 90 stocks in it, even though we're using the data for that. And then in 1957, it was as it is in its present form. Now, one important thing to understand about the S&P 500, and most indexes actually, is that they are what they call capitalization weighted. So capitalization is the size of a corporation. So it takes the number of shares multiplied by the price, and that has a value. As an example, Apple, which is a very huge company, if you take all the stock that's out there and multiply it by the current price, it has a market capitalization of about $800 billion. So that's what the company technically is worth. And the interesting thing about the S&P 500 in most indexes is that as companies get bigger, they have more influence on the performance of an index. So as an example, if you look at the S&P 500 right now, Apple has a weighting in the index of about almost 4%, 3.88%, compared to Citigroup, which is the 25th largest company, which has a weighting of about 0.83% or less than 1%. So even though there are 500 companies in the index, they all don't have the same contribution to the returns. The larger the company there is, the more it influences the return of the index. And we'll talk about that on another show, no doubt. But for right now, we're just trying to establish a baseline of what the S&P 500 has provided in returns throughout history. So if we go back for the last 50 years, equities, as represented by the S&P 500 index, has had an average return of 10.2%. So we had cash, the risk-free rate of return of 4.9%. Then we went out to bonds that had 7.9% returns over the last 50 years. And now we're at equities, which go out at 10.2% in average annual returns over the last 50 years. Now, I already know there's some of you saying, hey, yeah, but that's an average annual return. That's not what we get. And we've talked about that a lot on the show, and we'll dive into that. We're just setting a baseline here for some realistic expectations based on the last 50 years of history. Now, we're not quite done with this story. So we've established some basic return assumptions for the capital markets on a very big level, cash, bonds, and equities. But we all know that there's another factor in there. That is the nominal return, meaning the return without factoring in inflation. And inflation is something that we definitely have to factor in, especially when we're dealing with retirement. It's always a big topic. So let's factor in inflation over the last 50 years to get an idea of what they call the real return, the nominal return after inflation. One of the famous quotes from Ronald Reagan is, "Inflation is violent as a mugger, as frightening as an armed robber, and as deadly as a hitman." It's one of those things that hits us that we don't realize because it just creeps in as life unfolds. And it creeps into these returns as life unfolds. So let's look at that. So let's take those same returns. So if we look at the risk-free rate of return, T-bills, initially like, wow, 4.9% average over the last 50 years, that's not bad. If I do a 4% withdrawal rate from that, I should be okay, right? But if you factor in inflation, what inflation has been is represented by the Consumer Price Index, which is the basket that the government uses to measure inflation. Over the last 50 years, if you back out what inflation has been over the last 50 years, that 4.9% return, now the real return for the risk-free rate of return is 0.08%, which is basically nothing. So although that looks great on first blush, investing in cash as a strategy doesn't look like it's going to get anybody where they want to go, because if you factor in inflation, it basically returns, well, zero, pretty much. So let's go down to bonds. Well, if bonds over the last 50 years were 7.9%, you look at the inflation-adjusted returns as reported by DFA, bonds go from 7.9% down to a real return of 3.8%. Again, not close enough to get to that, magical 4% withdrawal rate everybody talks about. So now it's not near as attractive and doesn't appear that it's going to get us to where we want to go. Now, lastly, stocks, that beautiful 10.2% return over the last 50 years goes down to 5.9% inflation adjusted. That gets us over that 4% threshold. So it's clear that if we're going to build an investment strategy to help you live the life that you want, we're going to have to factor in inflation. And this is just the start of building what the expectations of the capital markets are. That's with cash, bonds, and stocks. Now, next week, what we're going to do is we are going to look at the other end of the equation, because getting that 5.9% real return in stocks does not come without a price, and you don't always get that, as we know. So we got to look at the other side of the equation, the risk equation, but this should give us a good foundation. Now, can we get off all this serious stuff and go get happy? Hey, welcome to the Happy Lab, where we noodle on how to live a happier life. Now, as you may have heard, if you've been listening to the show or reading Six Shots Saturday, I've started mountain biking again and had some mishaps. And the other day I had planned on going, and then all morning long I was internally talking myself out on not doing it. Oh, I'm too tired. I should do work around the house. I should work on my blog. All these things. For some reason, I was trying to talk myself out of going riding. But then I went anyway. Rode hard for a little over an hour and then sat at a bench in the forest after the ride, just sitting there looking at nature, seeing birds fly around, feeling the exuberation of riding hard. It's like, why would I ever not want to do this? And I guess the point is, there's probably a lot of things that you love to do that you sometimes talk yourself out of it. Don't.
On your marks, get set.
Hey, welcome to the Smart Sprint segment where we set a very little baby step to help you on your journey to creating a great life and great retirement. So we're talking about investment management here, and today we talked a little bit about weird science and building a foundation based on academic rigor and research. So what I would like you to do in the next 7 days is take all of your investment accounts that you've looked at and start to look at them from the eye of, okay, what's weird science? What's one of those 10,000 different kicks that I tried once and never tried again? And why do I still have it? Start to look at your investment accounts and your strategies from the eye of, is this weird science, or is there a real reason to own these particular things, and how do they fit into everything else into getting me to where I want to go? And why don't you start thinking like that in the next 7 days? Hey, thank you so much for joining me today on the show where we are starting the series on building a good foundation on how to invest wisely. If you are looking for a specialist to help you transition and live in retirement, go to rogerwhitney.com, click, and let's set up a time to have a video or phone chat and see if we are a good fit or whether I can direct you to a good resource. I want to thank you so much for listening. As always, it's a pleasure. I am Roger Whitney, the Retirement Answer Man.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.